All right. I want to welcome everyone to today's webinar. We are discussing something I'm always really excited to present about today. Today, we're doing a quarterly update on the multifamily market. We are in 2025. Time is flying like crazy. I can't believe we're already in quarter two and done with quarter one. So today, we're going to spend some time talking about what are we seeing in the market, in the multifamily market in particular, here in Q1 2025. We're also going to talk about data and some economics and what we're seeing in the economy and some of the headlines as well, and talk a little bit about how they impact the real estate market and how they impact the multifamily commercial real estate market in particular. If it's your first time joining us, I want to say welcome. Thanks for signing up for the webinar today. Hopefully, you get some nuggets out of this presentation. If you have any questions, please feel free to put them in the comments. I'm sorry, the questions box. I will get to as many of them as I can at the very end. So without further ado, let's dive right in. Right, let me pull that up. Let me pull up the Q&A box real quick. And there we go. Perfect. All right, let's dive right in. So I'm going to go full screen here and we're going to get started. All right, Q1 2025 market update for multifamily investors. If you want these slides, you see something you like, you want to look a little bit harder at the data, feel free to text this number 281-559-7061. You can also shoot our team a message at investor, investor at headwaycapital.us, and we'll get these slides over to you. Always happy to share and talk data. Just a quick disclaimer, this webinar is for educational purposes only. Should not be considered any legal or accounting or investment advice. We're just talking about what we're seeing in the market and how we're interpreting it. And obviously, it's open for interpretation for you. Please consult with your own attorney, financial advisor, CPA in regards to any specific investment or tax questions and how they may affect or impact you. A little bit about our team. If you haven't met us and it's your first time here on this webinar, I want to say welcome again. My name is Brian Alfaro. I'm the Director of Investor Relations here at a private real estate firm based in Houston, Texas called Headway Capital. Our company was founded back in 2018 by Sid Shamim and his lovely wife, Anam Omer, to help build and protect the wealth of busy professionals. Both were having success in their corporate careers, but having a big tax burden, and found that multifamily real estate was the best way to help alleviate some of that tax burden after they had built a successful single family residential portfolio. Our mission, our job, what we try to strive for on a daily basis is to provide multifamily investing opportunities, to find great multifamily investment opportunities that provide really three things for our investors. One is cash flow. I think everyone here on this call likes cash flow. Everyone loves mailbox money. Two, equity appreciation. We want to put your money to work outside of Wall Street, outside of the S&P and all the volatility we're seeing, into hard assets. And last but not least, tax benefits. We want to make sure we're helping you defer and put yourself in the best tax situation we can while keeping as much cash in your pocket as we can. And we have lots of experience doing it. We are now on our 8th year and growing. So excited that you're here. Here's a little bit about us. We have right around $440 million of assets under management, right around 3,000 units, give or take. And we have over 500 active investing partners that have partnered with us in the past. And we aim for a 25 to 30% average annualized return. And here's some testimonials for some of our investors. Again, always happy to share. And again, some examples of some properties that we've taken down here over the years, both workforce housing, B minus, C plus stuff, and A class stuff as well. Without further ado, let's dive right in why everyone's here. Let's talk about 2025, Q1 in particular. It has been a really interesting year already. Trump took office again in I should say late January, I guess. And we've seen just a crazy amount of volatility, in particular in the market. So I want to talk a little bit about the market and why this is important. If you're a commercial real estate investor, if you're a multifamily investor, watching the market and what's going on in the market is very, very important. So let's talk a little bit about what we've seen so far. The big elephant in the room and what everybody's talking about, just in casual conversation, at the bar, at sports games, is tariffs, right? These are some headlines on some things that I pulled. This is literally from today. Stocks rally as relief spreads through Wall Street. U.S. stocks rallied Wednesday after Trump said he has no intention of firing JP, easing Wall Street fears. So it's pretty crazy when you look at it. You see the Dow Jones Industrial Average over here on the right hand side, and this is just from the past 30 days, the amount of volatility and swings we've seen in the market, which is another reason why we love hard assets. Not that they can't go up or down. They can, of course, go up and down. It's an investment. There's risk involved. But the amount of short-term volatility we've seen in the market has been very painful for some investors. And I know I've talked to some investors who are looking to get out of the market and looking to get more into commercial real estate, whether it's through their IRA or their 401k, or they have some stocks that they're selling or sold at the end of the year to do some losses. But the market has just been really crazy, and every time essentially something is said about tariffs, the market sort of reacts to that, and it's been a pretty interesting journey for me to watch. Kind of sitting on the sidelines. I don't own a ton of stocks. I don't really play in that space, but it's a testament to why we like hard assets, and we've seen that in the S&P. On the top, you'll see month to date. This is as of today. The S&P is down, call it 5%, 4.92%, and then year to date, just in 2025. So, we're 4 months, 4.5 months in, the S&P 500 is down 8.38%, right? Which is tremendously painful because a lot of investors, just everyday people that don't know about private investments and hard assets, I mean, they're putting all their eggs in these baskets, the S&P and, their 401k and their IRAs, mutual funds, ETFs, things like that. And there's been a lot of volatility. So this isn't quite 2007, 2008 bad, but it's not fun to be on a roller coaster and feeling like you need to check your portfolio. And a lot of this, again, stems from the uncertainty in the market with all the stuff that has been enacted by the current administration. We've seen also, due to this volatility in the market, one thing we've seen is you'll see this pretty commonly when there's volatility and there's a lot of uncertainty is people like to flock to things that they consider to be safe, somewhat hard assets. And now Bitcoin definitely isn't a hard asset, but it often is very in line with what you see when you see gold. So a lot of people, when they see a lot of volatility in the markets, the stock markets, they tend to go and buy Bitcoin, which is what we've seen here. You'll see this is just the last 30 days. Bitcoin is up almost 9%. And you'll see the same thing with gold. In the last 6 months, gold was down a little bit today. Gold dropped after Trump said he wasn't firing Jerome Powell, which is kind of funny to be down 3.6% in one day, just because somebody said, yeah, I'm not going to fire that guy. But over the last 6 months, gold is up 21.41%, which is, again, just absolutely insane to think that investors are very nervous. And since they found out Trump won, there's been a lot of speculation and uncertainty in the market, which has led to a lot of investors to flock to non-traditional assets or more hard assets, I should say, like gold, silver, and Bitcoin. Even though it's not, you can't touch Bitcoin, but a lot of investors, they're very correlated, gold and Bitcoin. And with that being said, we've seen extreme volatility in the bond market and in the treasury market. And again, this all has to do with uncertainty. When there's uncertainty in the market, we're going to see a bunch of crazy volatility. So you'll see here a headline from today, the 23rd, 10-year treasury yield is unchanged after Trump backtracks plan to axe Fed chief. So Trump said, I'm not firing JP, and the 10-year treasury actually didn't change, which is actually interesting to see because there's been a lot of volatility in the treasuries because people assumed that he's been talking about potentially firing Jerome Powell. So the 10-year treasury has been a really interesting thing to watch, especially as there's a lot of headlines out there about, foreign countries selling their treasuries and not buying treasuries anymore to kind of punish the U.S. for all these tariffs and all that. And I don't know if necessarily I'm believing that. The dollar in the U.S. is still, one of the strongest currencies, if not the strongest currency still. And the United States is still a great place to invest long term. So I think this more has to do with volatility and people looking to flock to hard assets to avoid volatility than it does necessarily, countries potentially punishing us. But with all that being said, headlines are moving the needle here. You see that coming into 2025, the 10-year treasury approached 5%. It was sitting at right above 4.75% here. And then it's been just swinging all over the place. In April, when Trump started talking about tariffs, the market got super fearful. They thought the whole market was going to crash, and you'll see it just completely fell apart and dropped right under 4%. Got super excited. I thought it was going to stay there. And then it's just been volatile ever since. And we're back above 4.38%. So you might be asking yourself, if it's your first time on one of these calls, why the heck is this? Why are you talking about treasuries, Brian? Well, It's because our debt products, the loans that we get from lenders, Fannie, Freddie, bridge loans, bank loans, they're all tied to the treasuries. So if we're seeing volatility in the treasury market, we're seeing volatility in interest rates, is kind of long story short. So even though the Fed fund rate, the interest rate that the spread on the Fed has not changed, they haven't cut rates anytime recently and they haven't increased rates anytime recently in the past few months. The last rate cut was, I believe, in December of 2024. Rates have still remained elevated and they've remained volatile because the treasuries are volatile. So, again, I think people kind of they laugh at me when I say this, and I've had it. Lots of people bring this up in conversation. Somebody heard me say that I check this every day, sometimes multiple times a day. And it's true. I do look at this at least once a day, and partly is because I'm trying to drive the correlation between the headlines and what is happening in the treasury market to try to see where interest rates are. Because we're often looking to buy deals and refinance deals, and not knowing where the treasuries are means you don't necessarily know where our interest rates are. So, in the best interest of our investors, we have to keep an eye on these things. So, really, really interesting. So, with all that being said, how's the economy doing? We just talked about there's a ton of volatility in the market, but how is this impacting the actual economy? And the big thing that everyone's been talking about really since 2022, after the Fed realized that inflation was not transitory, was inflation. Whoops, my mouse is going crazy. Was inflation. Right. So inflation has been the beast that the Fed has been trying to play now since really inflation started rearing its ugly head in 2021. Really, they really realized, oh crap, this thing is not transitory. It's not temporary. In Q4 21, really Q1 of 22, they started cutting interest rates. I'm sorry, raising interest rates at the end of Q1 2022. And the rest is history, as you can see. So since then, the great news is we have made strides in getting inflation down, but we're not where we want to be. The Fed, now where they get this number from is beyond me, but the Fed is aiming, excuse me, aiming for a 2% inflation goal. They consider that to be a healthy number when it comes to inflation. They don't want it to be too low. They don't want it to be too high. They want it to be 2%. In March, the CPI, which is the preferred metric to look at, there's core PCE and then there's CPI. These are the ones that get reported the most, and they're both really good numbers to look at. The Fed's preferred method of inflation measuring is core PCE, but CPI is another one to look at. And the consumer price index fell seasonally 0.1% in March, putting the 12-month inflation rate right around 2.4 for all items, which is down from 2.8% in February. So we are seeing progress when it comes to inflation and in the markets overall, right? So this is something that's really, really interesting to keep an eye on. And you'll see the same thing on the chart on the right. We haven't really seen we've seen it slowing, right? CPI not growing, inflation not growing like crazy, but we haven't seen a lot of negative CPI prints. So the fact that March had a negative 0.1 CPI print is, again, just favorable news, meaning we're heading in the right direction. Now, the interesting thing to watch, kind of piggybacking on what I was just talking about, is this data is very rear looking. It's very backwards looking. What is going to happen to inflation when these tariffs actually are being felt? The impact is being felt in the data, right? That's to be determined, because these tariffs, some of them have been paused, some of them are not paused. China has a 145% tariff, I think, or something, really high number that is unheard of. Other countries have tariffs that are in place that are more reasonable, but there's going to be an impact to inflation with tariffs, because it's impossible to have tariffs and not to create some sort of inflation along the way, because things get more expensive. But what will be the impact here? Because we've seen a lot of tariffs on, tariffs off, tariffs on, tariffs off. But if companies are nervous and consumers are nervous, there should be some sort of impact on inflation, but time will tell. And this is partly probably why Trump is trying to get Jerome Powell to cut rates, but he's refusing to, is because he believes personally that that tariffs are inflationary, so he doesn't want to cut rates too fast, which is why Trump is saying, I want to fire you. So it's kind of an interesting back and forth to watch, but the data is very Interesting. From a job standpoint, this is the Fed's second hand. So their mandate is really to keep inflation in check and keep pricing in check. And their second mandate is to ensure Americans have job stability, right? Nobody likes being unemployed and getting fired, not being able to find a job for several months, if not longer. And monthly job creation in the US has been surprisingly strong. The data that came out for last month, which was March, the non-farm payrolls in March increased to 228,000 for the month, which is up from the revised 117,000 in February and better than the estimate of 140,000. So the job print that came out in March showing jobs that were created was way, way, way beyond what everyone thought it was going to be. We were actually expecting a much softer number between 120 and 140,000, and we saw 228,000 jobs created, which is pretty surprising. And there were some big sectors that were leading the way, like healthcare, and we also saw average hourly earnings increase by 0.3%, which is pretty much in line with the forecast, which is good. You want to see hourly earnings increase, and people make more money as things get more expensive. The sort of bad thing is that the unemployment rate moved up to 4.2% last month, which is higher than the 4.1% forecast. So even though job creation is really strong, there are still layoffs occurring. I mean, there's a lot of people on this webinar or watching the recording that probably know somebody that has lost their job, have been laid off from their job. I'm seeing it from friends and people that I talk to, and my wife's in corporate America and some colleagues, and it's happening around the world and around the US. So the labor market, while perceivingly strong, it often gets modified or adjusted, I should say. They have downward revisions every month, and January and February count saw pretty substantial downward revisions. In addition to the cuts of 34,000 from the initial count in February, January's growth was actually now at 111,000, which is 14,000 jobs less than the initial print. So, kind of long story short, this print that comes out, they printed 228,000 for March. What's going to happen is when April's numbers come out in May, they're going to modify the March print. And I've seen some crazy modifications before, but they can go from anywhere from 10 to 30,000 modifications. So the job market, we might see high 190s, low 200s, but still really strong job market. But the big highlight as well is that we're seeing an uptick in unemployment, which is what you're seeing here on the next slide. So unemployment is really one of those numbers that the siren starts to go off from the Fed when they start seeing this number creep towards 5%, right? That's the sort of magic number. Anything above 4% is like, okay, let's keep an eye on it. And then as it approaches 5%, the Fed starts to sound the alarm. We have a problem. And what's going to be interesting to watch, and where their hands often get tied or can be tied, is what happens if unemployment approaches or hits 5% and inflation is still not at 2%. Do you cut rates to spur job growth? But if you cut rates, what happens if that leads to higher inflation, right? So they're constantly like walking on this fine line in the sand and having to balance between both sides of not letting inflation get out of control while dealing with sort of the politics that come with the position, like Trump saying, "I'm going to fire you if you don't do this," but they technically believe he can't be fired, while also trying to keep American jobs. So it's been really interesting to watch. But so far, we've seen pretty strong job growth in 2025 Q1, and unemployment is relatively stable, so to speak, at 4.2%. So just another number to keep an eye on as we go throughout the year. And the other number that I like to keep an eye on, again, this all impacts multifamily because we are leasing apartments. And if people don't have jobs or people can't find jobs, then we have a big problem. That's when evictions grow up. That's when it gets really hard to raise rents, regardless of you renovating units. So we have to keep an eye on these things because they're all super important. So for job openings, my mouse is going crazy. For job openings, this is from the Federal Reserve, particularly the St. Louis one. You'll see here on the top chart the number of job openings. These are non-farm job openings have been slowly declining since March of 23. So it's about 2 years worth of data. We obviously, when inflation went crazy and rates started getting high, companies started laying people off. So it'll be really interesting to see this data on the amount of job openings we will see as the tariff data starts to come in their chart ended, unfortunately, in January of 2025. And then the bottom is a pretty interesting chart as well that showed the number of job openings per unemployed worker. And this is a newer chart that I actually found pretty recently that I found really interesting. So the job openings to workers ratio reflects the labor demand by showing the balance between unfilled position and available workers. So basically, a high ratio signals strong demand as employers are struggling to hire. So there's more jobs than employees, right? They're having a hard time hiring, while a lower ratio indicates weak demand due to a surplus of worker, right? It's like during COVID, for example, you'll see here point two, there's really weak demand because there's more jobs than workers, right? People were not hiring people during COVID. So in February of this year, there were about 7 million unemployed workers and 7.5 million job openings. So that's about a 1.07 job of 1.07 jobs available per unemployed worker, which is still significantly below pre-pandemic levels, right? So this is a pretty healthy position to be in, around that 1 to 1.25 line. If there's more jobs available than workers, then you have an issue. And if there's more workers available than jobs, you also have an issue. You want to keep a balance. So, again, just another thing to keep an eye on. Do we end up in a position where there are more unemployed people and less jobs? Well, we don't want that. That's, again, really hard and it can impact our apartment industry. So, let's dive into how this data and some other data as well impact the multifamily market, right? So we are multifamily owners and operators. We buy apartments, we operate them ourselves, we renovate them using our team, and we try to improve customer service, drive down expenses, and improve rents and increase income so we can pass that savings or those profits on to our investors. So, what's going on in the multifamily market, and how do all these numbers and some of the other data really impact what's going on? But I want to start off by highlighting something that's really important and to kind of keep in mind when you're looking at the multifamily market right now, and that is we are still facing a lingering housing crisis, which is driving long-term demand, right? So we're still seeing, we're going to talk about Houston in particular here pretty shortly. We're still seeing elevated in migration, so people are still moving here. So even though consumers are a little nervous right now, there's actually an index called a consumer sentiment index. I don't have a chart here on this slide, but consumer sentiment right now is pretty low. People are nervous. They're a little bit nervous, not only when it comes to investing, but they're just nervous in general. They're not sure if they're going to get to keep their job. They're not sure about their retirement funds right now because of the volatility in the markets. Should they wait? Should they invest? Should they not? What do they do right now? So I think when you're investing, especially when you're investing in real estate, you have to take a step back, sort of take a bird's eye view and think about the overall state of the landscape, right? What's going on in the market? And regardless of whether prices are up, prices are down, interest rates are up, interest rates are down, we have a housing problem, right? That's the underlying thesis here. We are only building new construction, $3,000, $2,500 to $3,000 a month apartments, which is not affordable for the average person. And there's just not enough homes, right? We haven't been building enough homes for a very long time. And even though we've had a lot of apartment deliveries come online, there's still an overall shortage, several million homes in America. So keeping that in mind, that still makes rental real estate, whether you're in the single family space or you're in the multifamily space, that still makes that asset class extremely attractive. So let's talk a little bit about what we've seen in the supply and demand field when it comes to multifamily. So we've seen really strong renter demand. So you'll see here, this is a chart from Marcus and Millichap, which is a organization. Not only do they provide deals to us, they do debt, and they also provide really good market insights. Renter demand held firm in 2024, marking the second highest absorption on record. So absorption is basically a fancy word for saying how many apartment units were absorbed, how many apartment units were rented. 2024 had the second highest on record. 663,000 apartment units were absorbed in 2024. And the forecast for this year is still to have a really, really strong market at 409,000. And when you're looking at the average across the last 15 years, that 409,000 is still really, really strong. So we are still seeing really, really strong demand for rental units and apartments in particular. And we're going to talk a little bit about why here in a second. And we're also, because of that, we're seeing U.S. apartment vacancy rate fall. The projections have fallen to 5.1% because of this strong renter demand, right? So we've seen really strong demand when it comes to renting, and that is causing vacancy rates to drop. So this is, again, this is a national average. This isn't just like Houston, but we're seeing vacancy rates drop. It was 5.6%, I believe, in 2024. And we're seeing if the forecast projected rate for this year ending to be 5.1%. So again, more people are renting apartments, and that's causing the vacancy rates to go down. Well, why is that happening? Well, this is why right here. So this is again from another research firm, Newmark. They have this really interesting data on renting versus owning. And I've got several interesting slides for us to discuss on. This is a big, big, big reason why we're bullish on rental real estate. So, if you're on this call and you're a single family investor and you can find good deals at cash flow, keep buying them. If you're in the multifamily space and you're a passive investor and we can find great deals for you to invest in, keep investing in them. And this is why. So renting more cost effective than home ownership is the headline here. So obviously renting is way more cost effective than home ownership, and the gap is 2.7 times remains 2.7 times the average. So, I mean, this chart is just absolutely insane. So, the spread between the total median monthly payment for home ownership and the average effective rent for apartments reached $1,120 at the end of the fourth quarter in 2024, which is a slight decline, but the spread has remained above the long term average of $416. So, the long term average on the spread between renting and owning for the longest time, this goes back to 2005, was $416. Well, since the apartment industry boomed right after COVID, starting in 2021 and 2022 and beyond, because homes have exploded in price, the delta went from $416 to $1,120. I mean, this is very telling on why people can't afford to buy homes right now. So would-be buyers are on the sidelines. And this data here is a chart that shows the purchase application index, which is basically showing how many people are applying for mortgages. So it says while the fourth quarter of 2024 recorded a slight increase in applications, the index is historically weak for much of the year. Since peaking in the fourth quarter of 2020, obviously people were money was almost free in the fourth quarter of 2020. That's when you're getting that 2% interest rate. The home application index has declined by 54% since then. So again, this chart goes back all the way back to 1990, which shows there's some parts of back in the early 90s where it was below this, but since then, I mean, this is a 20 plus year low when it comes to applications, which is just absolutely insane, which tells you where consumers are right now. And obviously, homes are not only expensive, but qualifying is also a really hard part right now because due to the price and the interest rate. So, as of October of last year, the annual shortfall between the median household income and qualified income needed to actually buy a house stood at $38,980. That is absolutely insane. That's a 49.3% gap, further constraining home buying affordability. So, what that means is the average person, they're going to go and try to buy a home, and there's a gap to qualify. And the gap on the amount of income that they need, that shortfall, is $38,000. I mean, that's like a big number. That's a salary for some people. That's, more than 50% of some people's salary, the average American, right? So it's just extremely unaffordable when it comes to buying a home right now. And you're seeing all this data come out. That's very, very telling. And again, keeps us really bullish on the multifamily industry. And that's really helping leasing, right? So this is some data here that is talking about the leasing demand quarterly and annually, and it skyrocketed in Q4 2024. So quarterly demand reached 238 units for the fourth quarter of Q4, while the rolling fourth quarter demand totaled 660K units, the second highest level in 25 years. Projections for 2025 indicate 487,000 units will be absorbed, making this third largest annual total record. So again, that we are seeing just record high demand for apartments, 25-year record high for demand in the last quarter in 2024, and projected to see another 487,000 units in 2025. So again, we are seeing a tremendous amount of leasing demand, and that is really stemming all from the unaffordability or the lack of affordability in the residential space, right? If home prices fell 50% and interest rates dropped, to 4%, 5%, then we would likely have the opposite issue. But we personally don't see a residential real estate crash coming anytime soon, just because there's no catalyst for that. The residential real estate market is frozen solid. People aren't buying or selling homes. And there's no catalyst like there was back in 2007, 2008, right? So if you were around during that time, and I was in college, but I have extensively studied how this happened. The housing market was crashed back in 2007, 2008, doing to, I would argue, bad lending practices. They were giving out what are often, if you research this, you can go look it up, giving out what are called ninja loans, NINJA, and that stands for no income, no job, no assets. So they were giving out loans to people at a 0% down payment. These people often weren't very qualified, and they were packaging these loans into the market because these loans get sold on the open market between traders, and these are called subprime mortgages, and they were selling them on the market. So what happens when you're an investor and you buy a package of 20 or 30 mortgages? And they rate these packages, on a different scale of, is this an A package, a B package, a C package? What's the risk here, basically? What happens when you buy a package of loans that has never fallen apart before, and all the loans in there are all from 0% down payment borrowers that all aren't qualified, that all have poor credit scores? Well, you just bought a crap load of bad notes, a crap load of bad loans. And what happens when the market crashes? Well, these people all hand you their keys and they walk away. And that's exactly what happened in 2008, which is what caused it was one of the reasons, a big reason why the residential real estate market crashed. And we saw pain in the commercial real estate market as well due to that, but that was the big reason on the residential side. Well, if subprime mortgages were the catalyst back in 2007, 2008 to cause a residential market crash to make homes quote affordable, well, what's the catalyst in 2025? Well, I don't see the catalyst personally. I don't see a thing. Borrowers that are in crazy situations because lenders have gotten really smart, they've gotten really savvy, they've gotten really good at qualifying people and making sure they're not stretched too thin. The only thing that I can think of, which would be a huge shift if it happened, would be massive, 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 massive unemployment, where unemployment goes to some record high number we've never seen before, 10, 15%, and people are handing back the keys to their house, not because they want to and they're in a bad loan, but because they don't have a job and they can't afford the payment, right? So that could happen in theory, right? Nothing's impossible, but I just don't see the catalyst. So because of that, we've seen strong leasing demand. And let's talk a little bit about Houston in particular. So as everyone here knows on this call, we're really bullish on Texas. We really like Houston. I need to on the next webinar here pretty soon. I need to do some other market research. Dallas is another phenomenal market. Has its risks. There's a lot of deliveries in Dallas, a lot of new construction projects, which can impact rent growth. But another really attractive market due to population growth. And in San Antonio is another market we are really looking really hard at. Not because we love San Antonio in particular, but a lot of the fundamentals are showing that are really strong in San Antonio. One, there's a lot of distressed deals there, so you can buy deals at a substantial discount, and it's a very large renter city as well, where there's still a massive affordability. The average home in San Antonio is still approaching 350, 400,000 for new homes. So the affordability there is tremendously large, just like it is in Houston. And they also have strong forecasted rent growth coming up in the next few years. So there's a lot of things about Dallas we love. There's a lot of things about San Antonio we love, but we're obviously based in Houston. So let's talk a little bit about Houston. So this is from a market report that came out for Q1 for 2025. So we're going to go through each one of these, but just some big highlights. Houston's obviously a huge city, and it's projected by Moody Analytics to add 496,000 residents in the next 4 years. It's home of 8 of the top 10 fastest growing markets nationwide. We're going to talk about that. We rank top 5 in employment growth, which is super important because we need jobs to rent people homes. We also see strong wage growth here, which again, we're going to talk about here in a second. Some other things, oil and gas employment is currently 25% below its peak during the fracking boom a decade ago. So total employment growth for Houston has surpassed 497,000 in the last 10 years, reflecting a significant expansion in other sectors. So we're very well diversified is what that is saying. And with record high home sales and elevated mortgages, Houston's average monthly principal, interest, taxes, and interest payments. So if you buy a house right now in Houston, the average payment you pay the lender, including taxes and insurance every month, is $3,665, which is 3 times the average of a multifamily unit in Houston of $1,274 for B and C class and $1,700 for A class. So whether you're living in a nice A class apartment or you're living in a B or C class apartment, we have gotten so much room here between the $3,665 it costs to buy a house right now and the $1,200 it costs to rent, which makes sense. That's why everyone's renting. And then in the multifamily industry, we've seen effective rent growth, surprisingly, at 0.7% through fourth quarter of 2024. So a lot of markets are actually down when it comes to rent growth. We've seen some negative rent growth in some markets like Dallas and San Antonio. It doesn't mean they're bad markets. But there's different factors that impact rent. But Houston, being a very strong market due to wages and job growth, actually saw a little bit of growth. It's basically flat, 0.7%, right? So that's really, really promising to see. And a lot of units are getting absorbed, especially in the Class A space. So let's dive into this a little bit. I want to talk a little bit more about some of this data that we're seeing here, but just really good stuff. So one of the things that make Houston really attractive, and San Antonio, there's a San Antonio County on here as well, and Dallas, there's a couple of Dallas counties on here as well, is population growth. I mean, we can't rent apartments, we can't build apartments if people are not moving here, right? So Texas in particular is, of course, has 8 of the 10 fastest growing populations counties in the nation, but Harris County is number one, right? So the amount of growth we're seeing here is just tremendous. And then you've got Montgomery County, which is northwest Houston, like the Woodlands and different places like that. And then you've got Fort Bend County, which is Sugar Land, Missouri City, different places like that. Again, we've got 3 of the top 10 fastest growing counties in the United States. This is not a Texas thing. In the United States, here in Texas. And then we've got Bexar County. Bexar County, if you're not familiar, is San Antonio. And we've got Denton and some other counties here that are just super, again, growing super fast and really, really exciting to see when it comes to Houston, which is why we're really bullish on Houston and, of course, really bullish on some of these other markets in Texas as well. And then, as mentioned, Houston has phenomenal wage growth, faster than rents, which is something that's really important to keep an eye on, because if rents are going up 10%, I'm just making up numbers here. If rents are going up 10%, but wages are going up 1%, well, you have a big problem, right? Because that 9% delta eventually is going to end up rearing its ugly head. And how are you going to increase rents 10% if people can't afford it? I mean, you can do all the renovations you want and make the property as pretty as you want, but if people can't afford it, they can't afford it. Well, the good news about Houston is wages are growing faster than rents, right? So you'll see here on this chart, increases in wages from 2022 and 2023 was 8% for Houston, but increase in rents was only 2%, 2.7%. So that's a 5.3% delta, which means people have room, which means we have room to increase rents, which is why we're seeing flat to slightly elevated rent growth at 0.7% on the last slide. And it's because people are getting an increase in wages. So it says here at the bottom, Houston led all U.S. metros in annual wage growth, nearly doubling the national average, and was one of only 4 markets where wage gains consistently outpaced rent increases both year over year and since pre-pandemic levels. This robust wage growth, alongside strong job gains, positioned Houston as the second fastest growing metro in the nation for the population growth in 2023, according to census data, right? So again, another reason why we love Houston. We've got great jobs here. People are moving here, and rents are not moving as fast as wages, which means people can afford to rent, and they can afford to see a slight increase in rents if we come in, buy a property that's not being managed well, not being taken care of, and we renovate it. Another thing to look at that's really important is how the market is performing overall. Now, this is all asset classes. So this is going to be your A class, your B class, your C class, and even the stuff that we don't want to touch, like the D class, sort of opportunistic, as they call it, type of assets, right? So there's 3,251 multifamily properties in Houston, which is pretty crazy when you think about it. 771,000 units, and the average effective rent is $1,274, which is $1.42 per square foot. And the average occupancy is 88.6%. So that's slightly lower than we'd like to see it. We'd like to obviously see occupancy a little bit above 89 to 90%. But that is okay. Houston has always historically had occupancy in the mid high 80s, which is, again, just something to make sure you're factoring in on your analysis. So I already talked about effective rents going 0.7%, and Houston stand out as the only major Texas MSA with positive rent growth. So again, Houston is the only MSA that has seen positive rent growth in 2024, which is crazy, right? So Austin, negative rent growth. San Antonio, negative rent growth. Dallas, negative rent growth. Again, doesn't mean those are bad markets, so I don't want to paint the wrong picture here. They're still phenomenal markets to invest in, depending on what the strategy is, but rent growth has been really stable in Houston, and it's the only one of those 4 major cities that had positive rent growth in 2024, right? And across the MSA, effective rents have risen 7% since Q4 of 2021. And that obviously has to do with our strong population growth and employment growth, right? And it's just a phenomenal market to invest in, right? So let's talk a little bit about rent growth and the future of rent growth. And again, some other reasons why we like some of the markets we've been talking about today. So Houston has a really strong future rent outlook. You'll see here, Houston is number 4. The other 3 cities are California-based cities. Houston is number 1 on outside of California for rent growth. 1.8% is the average effective rent growth forecast for this year for 2025 through 2028. So 1.8% is the forecast. It could be slightly lower, could be slightly higher, but that's a really strong number compared to the rest of the US. And then you'll see San Antonio is also on here at 1.2%. And then DFW, Dallas Fort Worth, is still expected, despite a record amount of deliveries and a record amount of apartments being built there, they're still expected to see 0.7%. Well, why is this all happening? Why is Dallas seeing rent growth? Why is San Antonio seeing rent growth? Why is Houston seeing rent growth? And it's because Texas is a phenomenal place to move. Houston has phenomenal amounts of jobs. Dallas has got tons of net migration and jobs. And San Antonio is, again, another tourist city, very blue collar market, a lot of job growth happening there. A lot of benefits that are happening in Austin have been passed on to the I-35 corridor in San Marcos and San Antonio. So we're expected to see strong rent growth. So again, really interesting chart to see. It's interesting to see Austin in here at 0%. I think that partly has to do down here with Austin just seeing a little bit too fast rent growth. It kind of exploded in 2021, 2022, and really just really kind of hurt the market. To be frank, it grew too fast, too hot, too fast. So they're expected to see a flat rent growth in the coming years. But I think Austin's still a great market. It's if you buy at the right price, you can still get rent growth. Let's talk a little bit about nationally. So we're kind of shifting a little bit here. We just talked a little bit about Houston. Houston, obviously a market we love. Let's talk a little bit about data we're seeing nationally when it comes to delinquency. So this is delinquency in loans. So the delinquency in a loan basically means that the loan is late. We obviously, when we buy a property, we're taking out a loan anywhere from 65 to 80% leverage. So that means we have to put anywhere from 40 to 20%, 20 to 35% as a down payment. That comes from the capital we raise from great investors like yourself. And of course, the money we put in as well, having skin in the game. And then we have a mortgage payment every month, just like you do for your home. Well, if we don't pay that mortgage, or if somebody doesn't pay that mortgage, you're delinquent, right? You're late on your mortgage, right? So this is the delinquency data showing from CMBS data on loans that are delinquent. So distress suppressed by widespread use of extension options, but Q4 saw a shift. So delinquency rates have risen, particularly in office and multifamily. We don't even talk about office. The multifamily rate nearly doubled. Despite this, loan extensions remain common, while nearly 200 billion, with a B, of outstanding balances maturing in 2024 earlier. Multifamily CMBS borrowers accounted for 44% of the increase in passive original maturity. So what we're seeing here, kind of long story short, is if you look at this data, so here's the CMBS delinquency tracker. Multifamily is in the gray right here. What we're starting to see is if you look at this data, now this starts all the way back from 2001. We're not looking that far back. We obviously saw a massive spike right over here during the great financial crisis, 2007 and 2010 and 11. But what we're looking at now is we're looking at current data. So let's look at the last 3 years, 22, 23, 24. In the multifamily space, you're starting to see this uptick in delinquency, right? This arrow is pointing this way, which is not good. That means there are loans out there that are delinquent, that are in trouble, right? And this chart over here on the right tells that very clearly. So this is securitized debt past maturity still outstanding. So these are loans that should have matured, but they didn't, and they're outstanding. So again, let's focus on the multifamily asset class. And there's some different categories here. So there's delinquent, meaning they're late. There's watch list, meaning they're potentially in trouble, and the lender thinks that something's going to happen pretty soon. So let's put them on the watch list. They're still paying their mortgage. They're not delinquent yet. They're not past their maturity yet, but we think they're going to be a problem because all the data we're seeing. Then there's special servicing, which is what happens after you get delinquent. So basically, I like to call this pre-foreclosure, is what special servicing is. It means, hey, you haven't paid your mortgage, or you are paying your mortgage and you're past maturity, meaning your loan was supposed to be due and you can't afford to refinance it, and you can't sell it because it won't sell for what your note is worth, or you won't be able to sell it for a profit. You move into what's called special servicing so that the lender can modify your loan or try to work with you to figure out a solution. And then there's loans that are not troubled that have extension options. So in the multifamily space, you're seeing a huge number of gray properties on the watch list, right? So let me change colors here. These are properties, $22.8 billion, that's with a B of loans that are on the watch list. These are loans that likely may or may not go into special servicing pre-foreclosure because there's something wrong, there's something going on here. Um, then there is another $3.9 billion dollars of loans, so a smaller number that are already there, right? And then there are 4.3 in loans, billion again in loans that are just delinquent. They're not fully in trouble yet, but they're a little late, and that's a problem, right? So right now we've got $51.3 billion dollars in securitized debt past maturity that's outstanding just in the multifamily space. So with all that being said, that is, my friends, where all of the opportunity lies. Because when people have loans and their loans are in trouble, they have to do something about it. Right now, the lender could decide to work with them, and they can modify the loan and not be in trouble anymore, and things are just fine. Or they could decide they want to take the keys back and foreclose on them and put it back on the market for sale. Or they could decide they want to sell it at a discount and do what's called like almost like a short sale, right? The loan, let's say the loan is got $10 million left on it and they can't sell it for $10 million. So they have to sell it for less, or they have to do something creative, like have a new buyer come in, give them the new loan, modify the loan and make it work. Well, that means they would be selling it for a discount, or you would be buying it at a pretty substantial discount. So there's a lot of opportunity right now in these three numbers right here, because I mean, combined 22 plus 4 is 26 plus 4 again, almost. It's about $30 billion worth of multifamily loans that are somewhat in trouble right now. So this is where all the opportunity lies. And I will tell you, here at Headway, this is where we are looking the most. This section here, we're looking for deals that are somewhere in this bucket. They're either delinquent, they're watch list, or they're already in pre-foreclosure. We did two deals last year that were in this $3.9 billion bucket, the special servicing pre-foreclosure, Shadow Creek and Ashford Park. And we want to try to find some more deals like that, or we want to find some deals that are on the watch list or just delinquent. So lots of opportunity in there, and this data is really telling, I think, what is coming, especially when you look at the fact that this arrow is pointing in this direction. Hopefully, we don't see a wild swing like this. That wouldn't be healthy for anyone. But a slight uptick in issues and delinquency could mean some good buying opportunities for us, which is exactly what we're looking for. So let me turn this off. There we go. Perfect. And you'll see here again, just kind of highlighting what I'm talking about here. When loans mature, typically you do one of two things: you either refinance, or you sell. And for the past decade, borrowers have been able to refinance at a lower cost. There's been this massive gap. So you want your gray line to be below your blue line. Your gray line is your bond yield, again, interest rates, and then the blue line is the apartment's value, right? Well, in 2021, this number inverted, and now rates are above valuations, which means if you go to refinance, the gap here is upside down. It's not good. If you refinance, you basically have to refinance and stick money in the property, which is why you can have what's called a cash in refinance, or you just have to sell the property for less than the loan value or at the loan value. So lots of opportunity again, and this is part of the reason why right here, which just emphasizes what I was just saying. So with all that being said, as we kind of wrap up here, I got one more slide talking about supply. And this is the last thing I want to highlight is U.S. apartment construction is expected to ease in 2025, but remain above recent norms. So we talked about this recently. I did a presentation earlier this year saying, will multifamily thrive in 2025? Kind of a catchy little thing. And this is part of the reason why is we are seeing a decline in construction. Last year, 585,000 units delivered. Completions, you'll see that over here on the left-hand side, which is a record high from the average of 329,000. But we're seeing that number come back down, which is good. We want deliveries to drop. We're buying existing assets. So if these numbers, if less properties get built, the existing assets go up in value because there's less new construction, and that makes it easier to go up in rents, because if you're not dealing with new construction as a competitor, it's easier to raise your rents, right? So this is another good sign. And the fact that supply is slowing down, there's not a lot of new construction coming online. It's going to make it easier for us to increase our values of our property. So with all that being said, we've got about 10 minutes left for Q&A as I kind of wrap up here. Is now a great time to invest in multifamily? Absolutely. I think the Fed's going to cut interest rates sometime this year. The projection right now is around summertime, possibly as early as June. We are obviously seeing a big uptick in distressed deals, as mentioned, particularly in markets like San Antonio. So I personally, I always recommend invest when deals are on sale, right? I like investing in a project if it's 20, 30, 40% less than the previous person paid for it. And I can get it on a really good terms. It might feel really uncomfortable to invest when your stock portfolio is down and you're feeling some pain, maybe in your 401k or your IRA. But this is the best time to invest because everything's on sale. Same for the stocks, right? Buy them when they're down, not when they're up. Single family homes are still overpriced, and there's a huge gap between buying and renting. We kind of beat that thing pretty hard today. There's a huge gap, and people can't afford to buy homes right now. So the theme, the message is invest now, sell in 3 to 5 years when the market is starting to boom again. So still a phenomenal time to invest in multifamily real estate. And I think there's a lot of opportunities out there. Again, we're seeing a lot of distressed deals, particularly in markets like Dallas. Dallas is starting to show some. San Antonio is definitely showing some. Austin is showing some distress. So we want to buy these distressed deals. They're in our backyard. They're in Texas. They're in a market. We talked about these markets having positive rent growth. We talked about positive population growth. Texas is a phenomenal place to invest. It's just going through a little bit of a tough time right now. And the good news about Texas in general is even when there's a recession, let's just say hypothetically there is one, Texas typically feels the pain very minimally compared to a lot of other markets. So, again, another reason to just be positive and bullish on Texas overall. So, with all that being said, I want to encourage anyone on this call if you haven't scheduled a call with me, you haven't spoken to me or spoken to Sid or somebody else on our team, um, sign up for our private investor club. That the way you gain access is by getting on a call with us. You have to be a sophisticated or accredited investor. And you got to have a phone call with us just to make sure you're qualified and you understand what you're getting into. And we'll put you on our private investor list, and that's going to give you access to our in-person events, property tours that we do very often, educational webinars like this one, and of course, give you access to our investment opportunities. So, with all that being said, let's open it up to Q&A here. If you have any questions on any data that you've seen, please feel free to put them in the Q&A. I love answering questions to the best of my ability. Still quite a number of people on this call, so don't be shy. Let's see what we got here. First, do you have any up and coming multifamily investment opportunities? What are you seeing in the market? Good question. So, we don't have an open multifamily investment opportunity today, but I get asked this question almost every time I speak to one of our investors on a call. But I feel really bullish and confident that we're going to have something hopefully in the next 30 to 60 days. But I will just say we're working really hard. We've got lots of offers out on deals in Houston. We've got lots of offers out in deals in San Antonio. We're looking at some deals in Dallas right now. There's lots of deals on the market, but we're just trying to make sure that our number one thing is we're trying to make sure we don't overpay. We really, really, really don't want to overpay for something and end up regretting it later, which obviously impacts all of our investors, including our company's reputation. So we are being very cautious and very careful and trying to thoroughly analyze deals. And then we're also looking for deals that have just a really good story and a really good opportunity. Again, that $30 billion of distress, that's really where we're focusing our attention. And we've got some things in the pipeline that I think might make sense here shortly. So I don't have anything for you today, but keep your eyes peeled. If you are looking to invest and you have some cash burning a hole in your pocket, I always recommend to our investors that you look into our income fund. We do have a fund that we have. It's a evergreen fund. It's always open. It has a liquidity component to it, so you can pull your money in and out of it within 90 days or less. It's for accredited investors only, and it pays an 8% annualized return for a $100,000 investment. And it is a hard money loan program. So we loan that money out to investors. They pay 12 to 13% interest on it, and we give our investors 8% of that. So that's the arbitrage play. So it's a phenomenal way to put your money and work in real estate while also waiting for your next investment opportunity. Because the second you want your money back, you send me a quick email with a quick form you fill out, and I usually get your money back. And we say 90 days, but it's usually more like 45 to 60. So another great investment vehicle if you're looking at for some cash flow. But we don't have any multifamily deals right now. So, but keep your eyes peeled. We're working on something. Let's see what else we got on here. Questions. What are your thoughts on the Houston market? I kind of answered that. So, Houston single family market in particular. Okay, so somebody asked about single family. I mean, I think Houston has a really strong rental market in particular. I do know I'm not in the single family space anymore. I don't own any. I have, I think, one rent. Yeah, I have one rental left that I own. But I got out of that space. But I do know that rentals are sitting on the market for quite some time right now in the single family space. And that's the beautiful thing about apartments, right? Um, that's the beautiful thing about markets, right? So um, the multifamily space, if you have an apartment, you have 100 units, say for example, maybe you have 85% occupancy or 88% occupancy. You still have 12 or 15 vacant units, but you're not 100% vacant. Well, in a single family space, if you own a rental and it's vacant, you're 100% vacant, right? You're not getting any rent. It's not like you're getting partial rent, which is a problem. So, with all that being said, I still like single family rentals. I'm not actively buying any or don't actively own any, minus the one, like I said, but I still think it's a good space to invest. You just, again, I'm gonna emphasize this enough. Do not overpay when it comes to any type of real estate right now. You don't want to get caught overpaying for something because that's what gets a lot of people in trouble. So, let's see. Question here from one of our Mr. Ed. I'll call you out here a little bit. It says that you seem to feel sorry for folks in the stock market because the market is down, but multifamily is also experiencing downturn. That is correct. It looks like there are opportunities coming in both stocks and multifamily. That is correct, Ed. Definitely don't feel sorry for anyone. I mean, we're all investors here. We're all smart. We're savvy. We when things go up, we feel great, and when things go down, we feel bad. But that's the name of investment, right? It's about time in the market, not timing the market. In my opinion, that's a saying that I've heard many times. I don't plan on exiting the multifamily market just because things are down a little bit. Just like I would not stop. Let's say like if I was a stock guy, I wouldn't stop investing in stocks just because the market drops. It's about learning the market, learning to. It's hard to time the market, which is why it's important just to keep your eye on the prize and always look ahead and kind of understand the cycles and the way they work. But I would agree there are excellent opportunities coming. If you're a stock investor, things are down, right? I would, if I was a stock guy, I'd be licking my chops right now, because I'd want to buy stocks when they're down. And it's the same for multifamily, right? We've seen valuations drop 20 to 30% here since 2022. Well, awesome. I want to buy some nice assets when they're down 20 or 30%. So good point, Ed. Let's see here. Could tariffs affect the cost of new construction or delay projects? That is a good question. I think so. So what I've seen so far is that from some people that I've talked to in the construction space is that they don't necessarily expect a short-term impact in some of the stuff. A lot of stuff, I know a lot of wood and different materials comes from Canada. And we do a lot of stuff here in the United States from a construction standpoint. I think it would be hard to say something like, no, it won't impact new construction or delay projects at all. But honestly, I don't have the answer to that not being in new construction. But I would say, just kind of high level, my thoughts are I think they will impact the cost of new construction. If tariffs are here and tariffs are here to stay, it's going to get more expensive to build new construction. Well, what happens when it gets too expensive to build new construction? People stop building it. Well, what happens when they stop building new construction? Your existing assets go up in value. So if that does happen and there's delays in construction and the cost of new construction goes up, I'm going to be excited because it's going to make my assets more valuable. Now, will it impact our expenses? Absolutely. We're renovating units too, right? So we're going to feel the pain of tariffs and different material costs going up over time. So it's not we're not shielded from it entirely, but I will say overall, I believe if new construction slows down due to tariffs even further, it's going to benefit the space even further. So, good question here. Between Austin, Houston, and Dallas, does one area typically have a higher rate of return on multifamily over the other two? I would say no, and I would encourage you to kind of reframe that question, Delbert, a little bit, or maybe your paradigm on it. I wouldn't necessarily be chasing a market based on the higher rate of return, just personally. And I am speaking from my passive investor seat because I'm a passive investor too. I invest passively both in our deals, of course, and then I've several passive investments in other people's deals. I don't necessarily look at a market be like, oh, I'm going to go to that market because the returns are higher on that market. I think it's about understanding the fundamentals of a market and why you would want to invest there in the first place, and then understanding what are the risks involved in that particular market. Because Austin, awesome market; Houston, awesome market; Dallas, awesome market. You can make money in all of those markets, Delbert. All of them. There's money to be made. I promise. The question is where's the upside in each market? Where's the downside? Where are the risks? Where are sort of the landmines? And how can you avoid that to try to maximize your return in each one of those particular markets? So I will say certain markets are better for cash flow versus certain markets are better for equity appreciation. So once you dig a little deeper, you'll start to understand that. So for example, I'll use an example here. You named Austin, Houston, Dallas. I'll throw San Antonio in there as well, since that's a market we're looking at. Houston is a pretty balanced market. You can find cash flow and it's going to have equity upside. People like Houston, the properties are going to go up in value. Dallas is more of an equity market, and it is harder to find strong cash flow in Dallas because it is so competitive and there's a lot of deliveries coming there. There's a lot of new construction in Dallas. You think Houston's bad? Dallas is worse. So that means Dallas, if you invest 100 grand in Dallas project, you're not going to see the same cash flow that you would receive in Houston, but your equity upside, the money you make when you sell the property, will probably be greater in Dallas than it would in Houston. And that's because cap rates in Dallas are lower. Houston's the same way. Austin's the same way. Austin would not be a strong cash flow market for me, but it would be a really strong equity upside market. There's a lot of California buyers, a lot of private equity groups, a lot of REITs that like to invest in Austin and Dallas too. So you're not going to get strong cash flow when you invest in something in Austin, but you might get really strong equity upside. And San Antonio is very similar to Houston, probably more of a cash flow market, not as strong as an equity upside market compared to Dallas and Austin, right? So it's not necessarily which one has a higher rate of return. I think you can double your money in all four of those markets, but understanding that one's going to have stronger cash flow versus upside. One's maybe going to have more execution risk versus the other, depending on the demographics and the job growth and sort of what's happening fundamentally. So I would go dig a little deeper when it comes to that question, Delbert, and just think a little bit more about, why do you want to invest in one of those markets? But don't just think about the money. Think more about the fundamentals. So that's important to note when you're looking to invest in the market. And also ask yourself, why am I investing? If you make great money and you don't care for, distributions because you don't really need $7,000 or $8,000 a year in cash flow you might be getting from one of these investments. If you care more about equity upside, you're somebody who just wants to make money on 3 to 5 years, kind of park your cash in the meantime, then the distributions don't mean much to you. Well, Dallas might be a great market for you. Austin might be a great market for you, right? Houston's good balance between cash flow and that. If you're somebody who's like, man, I really want some cash flow. I want some cash flow. I'm trying to quit my job. I want to replace my income. I want cash flow, or maybe I'm in retirement and I need cash flow for retirement. Then you need to find a cash flow market. And Austin and Dallas you can get some cash flow in Dallas, but Austin is not a cash flow market. Dallas is a weaker cash flow market. And Houston and San Antonio are going to typically have better cash flow because the prices of the property are lower. The rents are still pretty strong. So you can get better cash flow out of those markets, but you won't make as much on the exit necessarily. And I'm not talking about a 50% drop. These are small drops, but you'll still make good money investing in all those markets. So, but really good question. So with all that being said, it is now 3 minutes past the hour. So I appreciate everyone joining and asking questions. I hope this was insightful. Here's our information. Shoot us an email, investor@headwaycapital.us, if you want these slides. Go to our website, sign up for our investor list, schedule a call with me. I'd love to talk to each one of you and talk more about the market and what we're seeing and have good, healthy conversations about the market. I want to thank everyone for attending today's webinar. We do this once a quarter to do a market update. So look forward to the next one. And next month, we have a webinar coming up that I want to encourage everyone to sign up for. We do these on a monthly basis. So if you're not signing up for our webinars on a monthly basis, make sure you do that. So next month, looks like it is on May 28th. We have somebody talking about a DST versus a 1031 exchange. So if you don't know what that means, I highly encourage you to attend. Everyone probably knows what a 1031 exchange is. It's basically rolling your investment and deferring the taxes into another investment. Well, there's another alternative to that called the DST. And my good friend, Mr. Brett Stewards, is going to come talk about that for any of our active investment partners on here. So look forward to seeing you guys next month. Take care and have a great evening.